Hello everybody, my name is Christian Cholo. Welcome to your market report. Today we're Thursday, December 12th. Today folks, I want to make a follow-up on the last market report on December 5th when we talked about a movement in natural gas where there were a couple of stocks that were breaking out and a couple of stocks that actually I told you that you should watch for an eventual new breakout. Those stocks so far are continuing to perform well because natural gas is on fire. But today, despite the follow-up, I also want to talk to you about the current market situation though, because we had a correction for the last 2 days, but this correction is not a correction that allows us to say, okay, let's be in a shorting spree. Market seems to be not clear which direction they're going to take, so we're going to take a look at that in terms of which ETF that you could use to actually make some money under those volatile market conditions. Now, first of all, let's start with the natural gas. On December 5th, natural gas was clearly breaking out here. So I told you that this movement in natural gas, I was bullish on natural gas because of the GDP reading. Now, to trade that movement, you had an ETF that you could actually track is HNU. And HNU so far performed pretty well. So if you got it in HNU, you can definitely take some profit today. Advantage Oil and Gas was one stock on December 5th that was going up, but what I told you is that Advantage Oil and Gas, I didn't like it because to get in now on December 5th because we had all that resistance that's there and I was expecting a pause. Now on Advantage Oil and Gas, we're having that pause, we're confirming it. What's good is that we're staying within that sideways formation, so the new entry point on Advantage Oil and Gas will be higher than 459. Pay to Exploration was also a nice stock to get in. It clearly broke out, but Pay to Exploration, it's still a hold though. Even if it's having a slight correction, it's resisting the important correction that we had in the markets. So it's still a hold and you should only get out at 30.96 on the reversal of this upward trend. Berkeley Energy was among our analyst shorts on marketgurus.tv that you can have access for free for 10 days. It was recommended here on December 5th. So far the stock didn't perform much, but stay there within its triangle formation. It's getting at the edge of the triangle formation. And I think that with the volumes that are staying constant there, with the stochastics that so far is not yet oversold, it actually seems to be more tilting towards the overbought situation, which is confirming a bullish momentum. I think Berkeley Energy can easily reverse that important downward trend. So those of you who didn't get in on December 5th when I told you it was the best breakout of the natural gas, well, you'll be able to get in on the reversal of this downward trend. So let's say around 771 on Berkeley. But those of you who got in on December 5th, you'll be able to take some profit earlier on Berkeley Energy, and it was on marketgurus.tv that this stock was recommended as a buying signal. There was also Cabot Oil and Gas as a breakout on December 5th. So for that stock, it's still a hold. The trend is your friend. As long as the stock is maintaining its upward trend, you hold on to it. Now, this is it for the natural gas stocks. Now let's talk of the situation on the markets. Let's take a look at the SPY. The SPY today, if we take a look at the correction that I'm talking to you about, this correction here lasted for a couple of days though. So this is an important, since this important movement that we had in the upside, we had a correction that lasted for the last 2 days. Now we're having a slight technical intraday rebound. With this rebound though, we cannot say that as long as the SPY doesn't break that support, we cannot say that we have to be in a shorting spree, because if you take a look at some major sectors on the S&P 500, like the industrial sector or the consumer discretionary sectors, so far those sectors are still not able to break their support. So what's the strategy to benefit from that? Well, I think that so far the correction has some chances to continue. There's still a lot of uncertainty in the market. A lot of people are speculating that we're going to have an end of the quantitative easing program. The budget has been passed by the budget committee. It needs to be voted by the Senate and in Congress. John Boehner is behind this budget that was agreed on. So I think that we might see an agreement for the budget. And if the budget, there's an agreement on it, well, then the Fed will have not necessarily any incentives to continue the loose monetary policies, because the government will give more certainty to investors. So I think we might see actually a further correction, because investors will continue to speculate that we're going to have an end of the quantitative easing program. So that's why I think that the best strategy to favor and to benefit from this heightened volatility is through ETF like UVXY or SPXU. So those two ETF, since the correction began on December 12th, we told you it was an entry point on our swing trading show on decisionplus.com. So SPXU, UVXY, so far they're losing some momentum, but I think those ETFs still represent a good opportunity to get in, but simply for day trading. But if ever the SPY is able to actually clearly break that support, heads down with a lot of selling pressure, well then you would hold on to those bearish ETF until the SPY reaches 174.71. This will be our next target for the SPY if ever it starts a clear, credible bearish cycle, followed by a lot of sectors like the industrial or the consumer discretionary starting a bearish cycle. So this is the situation, folks, on the market. Bearish ETF, I think, are key because I believe that markets could have a correction for the next few days. So that said, it was Christian Charlo for MarketGurus.tv. See you next week for your market report. And never forget that the more money you make, the happier we are. See you next week.